This episode is brought to you by Acrolis. Every small business is different, but most lenders only see a snapshot. Acrolis gives SMB lenders the cash flow analytics, borrower behavior, and peer context to fund more, faster, and with confidence. Visit acrolis.com to learn more. Hello, and welcome back to the Fintech Takes podcast. Today, we have another episode of Not Fintech Investment Advice with our friend and the author of Fintech Brain Food, Simon Taylor. It's actually been a little while since we had Simon on, which is entirely my fault. And so in order to make it up to Simon, we spent a lot of time in this episode talking about AI, of course. We actually got to talk about a couple really interesting companies and sort of an interesting observation that we had about kind of AI in financial services that Simon and I had both sort of stumbled upon several years ago now that finally seems to be manifesting as a real trend in the space. So I really, really enjoyed that discussion. Simon also, as a gift to me, even though he didn't owe me anything, brought a really great fintech company focused on helping franchisees, which if you know anything about me and my interests, the overlap of fintech and franchising is sort of close to my heart. So I was delighted to hear about that one. We also spent a little bit of time maybe being slightly concerned about the direction of at least some things happening in consumer fintech, which again is a drum that I've been known to beat from time to time. And we ended with a delightful and really not at all relevant to fintech conversation as fintech dads and fathers of daughters who have some specific thoughts on media consumption and movies that are relevant to daughters. So got a little bit of time in for that at the end. As always, a delight to speak with Mr. Taylor. I'm sure you will enjoy this episode. So without further ado, here it is. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Simon Taylor is back, and we are Not Fintech Investment Advising. Simon, good to see you.
So good to see you, Alex. It feels like too long. Glad to be back and glad to not give any fintech investment advice, but learn a lot along the way.
I am pumped. It has been a while since we've had you on, which is entirely my fault. So consider this, Simon.
You've been crushing out the content. That B2B marketing thing was excellent, and some of the guests you've had on, first rate. You are hitting your stride, sir. It's a pleasure to see.
Well, I really appreciate that. That's nice of you to say. I still feel bad. So here's what I'm going to do for you, Simon. Not only am I going to let you go first with your company, but I'm also going to allow you to influence the list of companies that I'm going to be talking about. And we'll get to that in a second. So why don't you go first with one of your Simon companies? We'll start there.
Sure. This is called Primitive. And it is an agent control plane for large financial institutions for, you guessed it, AI agents.
Mm-hmm.
So it helps them manage, govern, and observe all AI agents throughout their estate from multiple providers. So that could be Anthropic, OpenAI, it could be something you've hosted yourself in your own data center into this single dashboard and this single hub. It tracks token usage, token spend, performance, outcomes, so they can quickly build these agents in one place, deploy it with multiple different models, and then see how much it's spending and see how much it's achieving. And there's this headline you might have seen recently, which is, I think it was the Uber CIO came out and said they burned their entire annual token budget in 4 months.
Yeah.
Since the labs have decided that the all-you-can-eat model of AI is gone. They're going to go public soon, so they're turning on the API-only billing for enterprise, and boom, it's like 8 to 13 times more expensive, depending on your usage. So, they got you addicted to the source, and then they jacked up the prices, and everyone's having this oh crap moment. And so I think this ticks a couple of boxes for me. One, I think every financial institution is trying to figure out how they do something with AI agents, and at the same time, terrified of giving their IP away to one of the big labs, right?
Yeah. Yeah.
And it's pretty hard to build your own agents on-prem. It's even harder to observe them and govern them. Like, engineers just want to start building, but you're regulated. You need to be able to explain all of this stuff. And you probably want to measure if it was any good or not, or did you just spend a whole bunch of money on AI and not see any outcomes? It's a really good study by Enber that said, in the 9 out of 10 companies of the leadership teams that they surveyed haven't seen any productivity benefit whatsoever from their AI investment so far. That's what's happening in most large enterprises. But the adoption is absolutely fine. Like, they're getting to 99% adoption in most companies really quickly. But you're sort of staring at this blank page, a bit like when you're starting an essay. It's like, what do I ask it? What do I do? To have this like Lego box for building agents, observing them, pulling from different models, managing your data firewall, I think is the next great platform. And I could imagine. So my question for this is like, well, shouldn't Microsoft be doing this? Shouldn't Salesforce be doing this? Maybe they are, but it's kind of big enterprise group risk and control GRC feeling stuff, but brought into AI. So what say you, Alex Johnson?
Fascinated by it. I saw when these guys announced when they launched. This is Derek's thing, right? Post Galileo,
Which, shout out to Derek. He's my old boss. Disclosure, he's a mate of mine. So, but I like this idea. There are other companies doing this.
No. I think it's a great idea, and I think, obviously Derek's experience in kind of these overlapping areas gives a lot of kind of credibility to this concept. I think it's fascinating. Obviously, as you said, everything about like, how do we govern agents? How do we sort of strike a balance as an organization between unleashing our company to really pursue building out AI agents while also not letting it spin off into crazy world? And that could be from a cost perspective, as you illustrated with the Uber example, but it can also just be like, you let the agent do what? You gave it what kind of data? Like what are you doing? And so I think the tension I keep hearing from banks on this is they're like, we could give everyone Microsoft Copilot, but that doesn't do anything for us. Like that, maybe makes some of our employees marginally more effective or efficient, but like it doesn't harness the actual potential of AI agents. Or on the other end of the spectrum, the non-Microsoft Copilot answer would be, we have a token maxing leaderboard and we just sort of encourage all our employees to go crazy. And that's just not going to work either. And so it does feel like there's an infrastructure gap for regulated entities that want to operate somewhere in between those two extremes. And so like this is like a single pane of glass sort of governance framework and operational framework makes a lot of sense. Obviously, the fact that it's kind of works across different AI labs or different AI models is, I think, really important, because I think we are going to see, and this goes to like what's been happening with Anthropic and Fable and all that kind of stuff, like we're going to see a level of necessary model independence, I think, coming up soon, where it's like, hey, the infrastructure we build, the guardrails we build, the systems we build, the processes we build, they can't be specifically built around one model, because one model might get turned off, one model might become much more expensive, one model might be jailbroken in a way that gives us some concerns from a data security perspective. So you need to have your infrastructure, your integrations, your processes, your guardrails, your monitoring, your governance built around something that's not the individual models or even like harnesses or stuff that you would get from specific AI labs. I also think, going to a point you made earlier, and I've been reading about this, and I don't feel like people are paying enough attention to it, but OpenAI and Anthropic are not forward deploying engineers into banks and core banking providers out of the goodness of their hearts.
No, really?
Yeah, I think it's.
I thought it was altruism.
And it's funny you say that, because like they like to talk about themselves as like, we're doing this for humanity. We don't really have any commercial concerns. Like, bullshit. Of course you do. And when you're an AI lab and you look at all the opportunities for agentic AI, where they seem to be honing in on outside of coding is really well documented, rigorously kind of process heavy industries where they need to build a new harness or a new set of agent workflows that are really specific to that context and that
Hmm.
industry and those sets of workflows. And obviously, like legal and law stuff is, I think, one good example. Healthcare is probably another one we're going to see this in, but certainly financial services fits into that category. And like they're forward deploying these engineers because they don't know these workflows. They don't have access to this data. They want to get access to it. And so they are taking advantage of the fact that FIS and Fiserv are desperate for an AI story that they can tell the market. A small little community bank like Customers Bank, like they don't really care about that. They just want to sort of be ahead of the curve relative to their peer banks. But I think it's kind of a prisoner's dilemma situation where if individual banks let AI labs sort of inside the perimeter, what are the AI labs going to do with that insight once they sort of gather it and once they map out these workflows? Are they just going to be content to like let all of the sales and all of the value accrue to banks and bank service providers? No, they're going to take some of this and spin off their own companies to sell directly to banks, or they might start their own banking service providers. Like we don't know how they're going to monetize that expertise once they have it, but there's no guarantee it's going to be good for banks. And so I also think in the same way that like to use a payment example, the same way that community banks kind of get nervous about the clearinghouse and tying into RTP because they have competitive concerns about the big banks, that
Yes.
same general type of thinking should apply to banks and how they choose to enable agentic AI and how they maybe try to keep the AI labs somewhat at arm's distance from that. And this would seem like a way to
Yes.
do that.
Agreed. I mean, the whole point of a Trojan horse is it looks like a horse. And you go, oh,
Right.
look, a friendly horse. I will
Right.
just
Right.
let my
Right.
gates open. Come right
Yep.
on in, horse. Oh, no, wait. Ah, there are Spartans inside. What do I
Right.
do?
Right. Right.
This
Oh,
I
they
wasn't
left it here for a
expecting this at
reason.
all. This was
Yeah.
so
Yeah.
unexpected.
Yeah.
And yes, the FDE is going in, and do you know what? They can rewrite your entire code base in weeks. Like writing code is not their problem. Shipping it is not their problem. It's know-how, it's expertise. And that is your IP. I was speaking to the board of one of the world's largest asset managers a couple of weeks ago, and they asked me that specific question: how do we protect our IP? And I pointed them to this example of Primitive, and I said, well, look, I'm going to say it, on-prem is sexy again. You
Totally.
can, with GLM 5.2 and the latest Kimi models from Moonshot, run 80% good to Opus 4.8 or even Opus 4.8 equivalent models on-prem for ultra low cost and run most of your workloads on it. And guess what? That open weight model is going to be even better and even better and even better. So how do you bring that on-prem, bring your token costs down, and then call out to the big AI labs where they can do something that you can't? And there will always be a benefit to something at the frontier, but you can then also be firewalling what that is. And I think there's also a slightly adjacent point, which is, what are your bits of IP? What are the bits of know-how you have, and what are the bits of data you have that you just don't want to get outside of your walls? And if those are your IP and those are what your special sauce, how are you going to utilize it? Because frankly, I think a lot of incumbents have really struggled to utilize it, which is why there's potentially going to be a resurgence in neutral third-party FDEs. At the moment in Silicon Valley, the whole FDE Palantir, but for a vertical, is a really popular model. You're seeing like McKinsey with FDEs type, rebrands coming out. And I can see that because I want something that's neutral, that's going to give me the engineering talent I don't, but that is taking orders from me. And I think that could be a trend to watch. And the alternative here is OpenAI has its Foundry product, which is a harness, but guess what? It only works with OpenAI stuff. And if you want to change it, you have to make that happen. So I think that sort of Faustian bargain is one that a lot of boards are aware of, and it's a lot of boards who are sort of antsy. They know they need to do something, but they'd rather not make a mistake than anything at all. And then they set up these centers of excellence and it looks like innovation theater. But also they've got their business, and that's not eroding anytime soon as long as they sit on that data and that know-how. So they've got a bit of time. The question is, how do they use it? Because the companies that are using AI really well in finance have an enormous tailwind. You look at the amount of product, like if you look at the companies that have been growing fastest in finance, it's the ones that ship code the fastest, new features the fastest. Revolut is a great example of this. At any one time, they're building 20 new products, of which maybe 10 or 5 will make it to market. Each one is seeded with $3 million, and they do that every quarter. And they agree up front what the KPIs are. I can't name other legacy institutions that move at that sort of clock speed. And they're on track to be a $100 billion company and beyond, and growing their revenues incredibly quickly. They're profitable as well. So this is not like a crazy thing. They just got their UK full banking license. Never bet against those companies that are using AI as a tailwind. And there are finance companies that can. So I think you've got a window as an incumbent to make sure you get this right. I think the answers are known. They're in the market. But, be wary of Greeks bearing gifts.
Yeah, I mean, it's a great point. The on-premise sexy thing, I just can't emphasize that enough. I mean, it does remind me a lot in an accelerated way of what we went through with public cloud, right? I remember I wrote this piece
100%.
a long time ago where I was like, hey, maybe we shouldn't just be handing everything over to AWS without thinking at all. Like maybe that's a bad idea. And people like looked at me like I had lost my mind because it was so not the conventional wisdom at the time. But then you saw this whole like repatriating workloads off of public cloud, having a multi-cloud strategy. And it's like, the answer is, I'm not saying don't use the cloud. Obviously, everyone uses the cloud. Everyone should use the cloud. But don't thoughtlessly use one public cloud provider that you just give all of your data to, that you just sort of thoughtlessly tie yourself to with all the developer tools and little bells and whistles they give you. And AI seems like a massively bigger version of that same Trojan horse concern. And to your point, I actually give a lot of companies credit that they've gotten to this realization a lot faster. I think the AI labs maybe have been a little not as subtle as they needed to be in order to like reassure the market in that way. But people seem to be getting to this idea quickly. So Primitive seems like it's well positioned to take advantage of that. Simon, again, as the second part of my apology to you, I would like you to tell me what my first fintech company is to talk about, because you brought one to the table that just seemed like a very Alex type of company.
It really did. I couldn't have this company in my mind, which is such an Alexy company, and not share it with you. And you agreed, which is lovely.
I did.
I've done a few episodes with you now. I know you. So this is called Exponent Fi. It is the franchise finance platform. So it helps franchisees manage their loan. It uses AI to help them manage all of their accounts and issue corporate charge cards to manage their expenses. For the lender, the loan dashboard creates a single deal room for all document intake, tracking, and closing. And I think this is a really obvious play to collect a lot more data out of the franchisees to be able to do better underwriting.
Yep.
Really logical when you think about it. And today, the banks don't see a lot of that data, or if they do, they all see it in a somewhat ununiform way. And, a franchise loan is a small business loan is another type of loan. They're not really specializing in it. So by giving both sides the tools to make their life easier, they get better data. And Exponent Fi is a licensed SBA lender in all 50 states for this type of lending. So franchisees, it's not a segment we talk about a lot. Small business lending feels like very much in the Alex Johnson wheelhouse. So what say you, Alex?
I'm so glad you brought this to the table. I'm glad we included it in the outline for today. Love it. Love it, love it, love it. And I will say in particular, we don't talk about franchises or franchisees very often. I don't know that we've ever talked about it on this particular show. I have spent some time on it over the last couple of years. I used to have a
You
colleague
opening
actually
a Pizza Hut? What's going on?
well, I had a colleague who
Yeah.
wrote a newsletter about the franchise industry. And so I got to kind of learn a little bit about the franchise space. And what I realized after learning a little bit more about it is, and this might sound like a bit of an overstatement, but it's not really. Franchises are one of the most predictably effective paths to wealth building in
Yes.
the world. Like it is what basically the way it's been described to me is, look, it's a business in a box. It's entrepreneurship in a box. Like, here's how this works. Here's the playbook. Here's the operation. Here's the brand. Here's all the things you need to succeed opening a business. And obviously, franchising as a model applies across a huge number of different industries, right? It's restaurants, as we all know, but it's also like, gutter cleaning businesses and tutoring businesses and just all kinds of stuff. Like you can franchise any type of business. Franchising is just the process of putting it into a box, getting franchisees, operating the overall franchise, ensuring that the franchisees are being successful. Like it's a operational strategy that can apply to any industry. However, as you point out, franchises and franchisees have a really hard time managing just all of those processes. If you've ever tried to buy into a franchise or to become a franchisee, it's very expensive. And that expense, you can get loans for it, obviously, to start a franchise in, the geographic area that you're looking to operate in, but it's very expensive. So you need a loan. A lot of times the people who are trying to get the loans don't appear on the surface to be people that have like a great track record or credit risk history, right? I mean, the point of a franchise is that it's oftentimes someone's first stab at entrepreneurship. And so they don't have any like real track record to fall back on. A lot of franchises are started actually by like recent immigrants or people who don't have a lot of like established economic history in a particular community. And so it's really hard to underwrite. And what ends up happening, whenever anything is hard to underwrite, what ends up happening is there's a very specific set of specialized lenders that learn to kind of de-risk that space and focus on that space. And then, not to be too overly harsh, but those specialized lenders then have the opportunity to screw over the people they're lending to, because it's like, where else are you going to go? It's me or them, and you should deal with me because you've already come to me. Like, you don't have any choices. And so you don't tend to get great pricing. There's not a lot of competition for your business. A lot of times it's not very transparent in terms of what the costs are going to be. There is some SBA lending that happens in the franchise space, but like SBA lending is its own whole specialized process that you have to go through. And if you're an SBA lender, oftentimes there's better ways to do SBA lending than to focus on franchises as a sort of target within SBA lending. So I love the idea of creating a platform that can create essentially more competition, I would imagine, and bring more like competition to this particular segment. And the idea that you can use like AI, obviously, to just shortcut the process of gathering all of the information, collecting all the documents, like that all makes a ton of sense. I also think that there is an underrated opportunity to build, and I don't know if these guys are doing this yet, maybe it's on the roadmap, but like you can start with franchisees, but over time you can build like data models and even underwriting models on specific franchises, right? So you can go, hey, if you're looking to open a Crumble Cookies versus a Domino's versus whatever, like we understand the nuances of underwriting one of those types of franchises versus a different one. You can maybe even develop like formal business partnerships or relationships with the franchises. So there's just a lot of ways that can spin off in a direction that I think is very positive. And then it seems like the other thing that they do looking at their website is they also like try to layer on the AI bookkeeping and accounting and, as you said, expense management and charge cards. And the thing I like about that is that then allows you to build sort of a recursively improving understanding of that business and potentially of that business owner. Because the other thing that happens in this space is you do one franchise and it works, and then you do it again, and then you do it again. And so the people who end up being these sort of secret multimillionaires who you'd never expect are like ultra wealthy people, but actually are these people who own like 12 Orange Juliuses spread across, 3 states or whatever, right? And it's like, it's a very strange form of entrepreneurship and wealth building, but it's really successful. And I think it'd be a very cool opportunity to be able to build a relationship and a financial profile and just sort of like a financial operating system essentially for these entrepreneurs that as they scale up and add more franchises, you're just getting more opportunities to lend to them. You're getting more opportunities to facilitate payments. Eventually you're getting opportunities to do like private wealth management and other types of banking services for them. And so the flywheel, as you start to get that going, seems very attractive.
I mean, how many franchises does Shaquille O'Neal own?
It's
I
a
think
bunch.
he's I'm going to quickly Google it whilst we talk. 155 Five Guys franchises he owned at one point. He had 50 restaurant franchises, 40 health clubs. I mean, this is a guy who went on to make more after playing than he did during playing, and he owned a lot. And a lot of it was baked on that franchise stuff, and now he does speaking kind of largely off the back of it. And that sort of path to wealth is one that I don't think people shine the light on a lot. We sold the dream of own your own home as a path to wealth, but own a franchise is probably a better path to wealth. And it's kind of one of those where we don't talk about it because, I looked into it, my local area, and I can't help myself. I've got that little bug where I'm like, oh, that's a nice piece of real estate. I wonder if I could stick a whatever there. And like, nobody ever brought Cinnabon to the UK, and that would clean up because, we're just as much into our junk food, pre-GLP-1s anyway. And so I would see all of these things and really want to do it. But every time I was like, God, this is such a time sink, just even trying to get it off the ground. I need a person who just does this, or I need to quit my job and just do this.
Well, and I will say on that note, and again, this goes to that specialization thing. I didn't know this until I dug into the franchise space. There are franchise brokers that help you if you want to buy a franchise or buy into a franchise. But again, guess what? All kinds of bad behavior happening in that space. Because there are these specialized people who know these things, and they're like the gatekeepers to this form of wealth, and they extract a lot of value out of sitting at that spot. And so getting rid of those people or sort of shunting them a little bit to the side using a platform that sort of opens up access, huge, huge value add.
I think there's so much to be said for that value add that you can bring from just trying to bring a bit of transparency to something. So yeah, I thought this was a very, very Alexy company.
I love it. I will say for the few people who might be listening who know this reference, my dream of opening up a franchise business would be a Taco Treat, which is a very, very small franchise that I think mostly just operates in Montana. I don't even know if it's outside Montana. And it's, Simon, like my single favorite restaurant. And there's one in every city in Montana except for Bozeman. So my dream for many years has been Taco Treat franchise, brought it to Bozeman. So if you ever see me quit the newsletter, quit the podcast, that's likely what I'm going to be doing. This episode is brought to you by Ocrolus. Most SMB lenders are making credit decisions on a snapshot. Raw cash flow numbers, no borrower behavior context, no sense of how that merchant compares to peers. Ocrolus fixes that. Expect cash flow analytics, borrower behavior, and industry benchmarking, all built directly into the underwriting workflow. Visit ocrolus.com to learn more.
Now I know what I'm going to do to push you out of this game so that I can have so I can have some airtime and some space. Just
there you go. There you go.
That's the political move, people.
Just
anybody who's threatened by Alex
Johnson's
Johnson's talent, just that's what you do.
That will be the secret to getting me to quit. So if I could make that happen, that would actually be my dream come true. Excellent choice, Simon. Give me your second fintech company.
Okay. I'm going to talk about Prime Intellect. Now, this is kind of following on from the first one a little bit. It's not strictly fintech, but I can see that actually Ramp is a big customer, and as are a number of other companies I know about who ask me, we're starting to train our own model on our own custom data. We think we want to do underwriting. We think we want to do something with an LLM, but a custom version of an LLM, not something from one of the big labs. And we don't want to just take something that's open weight. We need to fine tune it to our use case. So that's exactly what Prime Intellect does. They train, deploy, and continuously improve models on an integrated stack for compute, post-training, evals, and inference. So basically everything you need to do to train the thing, keep continually training it, and serve it with the inference. And they have a whole case study about how Ramp built their own model. But I would point you actually at Revolut and Nubank, who are not case studies on this website, as companies who have trained their own models, right? And instead of training those models on language, they train them on financial events. And why is that important? Well, Revolut discovered that they were 69% better in a key metric around fraud than their existing machine learned models. Those machine learned models must have had tens of millions of dollars of time and attention put into them. They did one experimental sort of foundation model, and they saw massive uplift. And it was really like a GPT-2 class of model. It wasn't particularly forward thinking. I think they had a 39% uplift in one of their credit underwriting KPIs as well, and across the board. And this was the same model that did the fraud and the credit underwriting. So what they essentially did is they took every customer event, a transaction, a website login, a click, whatever it is, and they turned that into vector space and a set of embeddings instead of the English language. And so what they could do was predict when somebody was likely to take a new product. They could predict when something was likely to be fraud. They just had this predictive capability, this generative capability that they didn't have before. So this kind of goes back to the last point on primitive, which is like, what do I do with my IP? You go to something like a Prime Intellect, you get your data and you start to begin to train your own custom models and you fine tune them. I had Pahal Patangia from NVIDIA on the Tokenized podcast a few weeks ago. They work a lot now with financial institutions doing this stuff. And he's been saying for the last 2 years, he's been so surprised by how few financial institutions have been trying to run their own models. And there's like so many blueprints that have already been built for you to do this. Revolut's model that they built took them 6 weeks. And most of that was just designing the experiment. Actually, the training didn't take long at all. I think it cost them less than $500,000. This was not expensive as an endeavor at all. So what does Prime Intellect do? They host all of the evaluations and will help you figure out what your evals should be. So how do I know this model is performing? What benchmark should I have? They'll host the training. They'll then actually allow you to deploy that training either internally or across a bunch of neo clouds that are really inexpensive rather than on a hyperscaler, and then build you feedback loops to kind of improve the model. And the head of applied research at Ramp said, this is just a huge differentiator that made life 10x easier. We've had Vibe coding and Vibe finance. Now we're getting Vibe model training. They really have simplified it. So, people are so worried about how am I going to make sense of my competitive advantage? How am I going to use my data?
Yeah.
The biggest problem, as always, with anything is, can you actually access your data? Right? For the large financial institutions, especially those beholden to a core banking vendor, actually accessing that and bringing it into a data lake, pretty hard. But if you have Databricks or something like that, and you're a reasonably sized enterprise, Snowflake, there you go. Anything like that, boom. Go play with this. So again, an ultra simony company, not strictly fintech, but it's not fintech investment advice after all.
That's right.
And I didn't even go down the whole rabbit hole I've been going down lately with the can you turn compute into a commodity? But that one's for another day.
Well, no, I think it's really fascinating, and strangely, this is an Alex company because an area I've been digging into, similar to you, is this question of like basically some people call them like small language models. This is like basically substituting, as you said, financial data in for language data, but using transformer architecture and attention-based mechanisms in order to understand the data. I remember this was a few years ago now, but Stripe came out with one of these, right? Where it was like a fraud payments model. And I
Yes.
remember reading this like post by the data scientist who built it. And he was like, yeah, the thing we didn't know until we tested this was, does fraud payment data have a similar syntax and internal structure to language that would allow you to apply transformer architecture and attention-based mechanisms to it in order to find things that we can't find with gradient boost machine learning models? And the answer, it turned out, they didn't know when they did the test, but it turns out yes. And I mean, Stripe, obviously, no one's more sophisticated about like being able to like predict fraud based on payments data. They've been studying it for years. And like this new technique completely revolutionized their approach to doing it and outkicked what they were able to do with their existing machine learning models. And it turns out, as you're saying, that technique is applicable all over the place. You can apply it to credit data. You can apply it to fraud data. You can apply it to payments data. You can apply it, I'm sure, to insurance data. Like all of these proprietary internal data sets have their own structure and syntax. And if you apply that into vectors, you can use this architecture to understand it and to find nuances in it that you wouldn't be able to find before. Two other examples of this, you mentioned Nubank, right? One of my favorite under the radar acquisitions over the last couple of years was Nubank acquiring a little company called Hyperplane
Yes.
that was back in 2024. And
Yes.
this was what Hyperplane was doing too, right? They specialized in going into a bank, picking out these large data sets that they had, these proprietary data sets on collections, marketing, credit risk, whatever the results data was, pouring through it and using transformer-based architectures to better understand what was happening. Nubank very, very smartly took them off the market where they could start working with their competitors and made it like an internal capability. But this has been a thing. FICO has really eschewed like transformers and large language models because they don't think it works well for credit risk. They came out and launched their own approach where they're doing small models trained just on credit
Yes.
data, which obviously they understand very well. Another example of this that I wrote about recently was a firm came out and shared at their investor day that they've been experimenting with the same thing. And they built their own version of a model, again, based on this different architecture. And what they found is, again, a firm, no one is smarter about underwriting credit data than them. It outperformed their existing gradient boost machine learning models. And the analogy that someone at a firm gave me that I thought was a really interesting way of thinking about it is, it's like looking at sort of time series data to pick out nuances that you wouldn't see before, right? And the analogy is like, if you're at the end of a basketball game and you're trying to predict in the fourth quarter, who should we foul who's going to have like a bad free throw shooting and won't make the free throw. Well, you could look at that person's aggregate statistics over their career or over the season and go, that's a good free throw shooter, that's a bad free throw shooter. But another thing you might want to know is, who's gotten fouled 6 times in this game and who has missed every single one of those shots. And even though statistically they look like a good credit risk, based on our experience looking in this game at the last 6 free throws they've shot, it doesn't look like they're going to make this next one. And you might choose to foul that free throw shooter as opposed to a different one. So this ability to like go in and look at like very granular, very hard to see relationships in your own internal data, it allows for you to just see stuff that you wouldn't see otherwise. And I think it's worth pointing out that you don't have to operationalize this type of insight that can be generated by these models using like large language models, right? And so like all the concerns you have around hallucination, replicability, predictable nature, like those things all go away because you're not using this transformer architecture to like drive customer decisions. You're using it to improve the way you discover features that you build into predictive models. And so to me, this is absolutely like a no-brainer that everyone should be doing. And the architecture, as you point out, this is the thing that people don't know how to do. And so I love that these guys are working on that.
I think transformers are the point. In my State of FinTech 2025, I covered Hyperplane. And that was like, so I wrote that at the end of 24. And I was like, why is nobody doing this? Yep. And in the 2026 report that went out at the beginning of 26 was like, why is nobody doing this? The only one, I'd only found 2, which was Nubank and then the Stripe example. Now, finally, it's starting to creep out into the ether and people are doing it. But I have 2 signals. This is the advantage sometimes of being a video gamer. NVIDIA on the video game side moved their upscaling technology that makes video games like go a bit faster to use transformers away from machine learning. Why? Because it was more effective. The other thing I saw is that the Collison brothers invested in the Arc Institute, which is a non-profit designed to predict and generate DNA sequences.
Yeah.
And that was not trained on human language.
Yep.
And the NVIDIA model for DLSS4 was not trained on human language. It was trained on different images. So your training data set is predicting different things. And your financial data set is potentially different. What's really interesting, again, about the Revolut model is how widely applicable it was when you look at event sequence.
That's fascinating. I didn't really, I'd never seen or heard of an example like that one where it's not a specialized like payments data or customer login data or credit data. They did all of it, it sounds like.
Yeah, so I spoke to the guy behind it who wrote the paper, Pavel, in the piece I wrote that I've sent to you for your research.
Yeah.
I will, listeners, you're in on this, but I'll introduce Alex to Pavel and to Pahal Tangier at NVIDIA because the stuff going on in this space, it's just starting to surface. And Prime Intellect is one place, there will be other places. But I do think this is going to be the big answer to the question, how do I differentiate in the age of AI? How do we not go from the SaaS apocalypse to the finance apocalypse?
Absolutely. I will drop a link to some of the stuff Simon has written on this stuff. I also did do a podcast a long time ago before the Nubank acquisition with Hyperplane. And
oh, wow.
It felt like looking into the future. I rarely take, it was what same thing you're describing where it's like, they reached out to me cold, like just through a PR person. They're like, oh, whatever. And I never take cold pitches almost ever for like the podcast. Like it's a very rare thing. But I was like, oh yeah, I'll talk to him. And I talked to him and I got off the call and I was like, holy fuck. Like, that's like, man, that is like a window into the future. And I was like, you have to come on the podcast and describe this. And so it is gratifying to see this breaking through as more mainstream infrastructure that people know they need. Whereas the last couple of years, it's felt like a secret that some people knew, but other people didn't know.
Yeah, it's like when your weird little nerd hobby suddenly becomes popular, like fintech. I mean, that happened to both of us at one point.
That's right. That is exactly right. All right, Simon, can I give you one more company?
Let's go.
All right, this one is Covered, Corverd, so no E at the very end, but Covered. They are a consumer credit card provider, I guess would be the right way to describe it. They just sort of launched the card most recently, so that's kind of how they popped back up on my radar. They had been on my radar for a little bit longer, though, because they are advancing a very sort of gamified, or I would even argue perhaps casinoified interface for spending and credit card rewards in particular. So very early company, about $8 million raised. They described the product as, or the roots of the product. This Week in FinTech wrote a good profile on the company as a part of the most recent launch. And they were talking about how they came up with the idea because they were pitched to angel invest by a different entrepreneur who was building basically like a punitive budgeting tool where whenever you would overspend, the app would take money away from your bank account and lock it up in an investment account or some other place and find other products that were cheaper. And their reaction to that pitch was to go build what they thought of as the opposite of that pitch. So instead of making money punitive and trying to coerce you into doing good things with your money, they built a product that gamifies spending and makes it more fun. So there's two components to it, Simon. One is a credit card that basically uses like variable reinforcement as the sort of reward mechanism. So instead of getting a steady 2-3% on a particular category of spending, instead you will sort of randomly get 100% or 50% or 25% cash back according to an algorithm that they've built. And so the basic idea or the example they gave is like they have a bunch of different categories, and the categories will be like the category of spend, the time that it's happening, the amount of the transaction, the location of the transaction, the last two card digits for the specific cardholder, and kind of like a slot machine. If all 5 of your transactions at any one time hit those 5 categories, you get 100% back. If you hit 3 of them, you get 50% back, that kind of thing. And the way they are ostensibly designing it is that you are still overall getting paid out like 2 to 2.5% cash back, but the algorithm they've built kind of predicts where their spend is going to come from, and then they apply that in this kind of randomized, gamified way for getting cash back. So the idea is to tap into that sort of dopamine circuit that consumers have and that we seem to be building our entire economy around these days, where it's like, I would prefer the chance of winning big to the certainty of winning small. So this is like the credit card reward version of that. Now, when you win cash back, you can either take it out as a statement credit, which is kind of the common way of doing it, or you can take it back into something called covered cash. And this ties to the other part of the product, which is the part that they actually launched before they launched the card. And this is like a sweepstakes sort of lottery casino-esque gaming experience. So the idea is you go into the covered app, you can play all these little kind of mini games that they have in the app and different contests that you can participate in to win different prizes or other things. And to play in any of those games, you need covered cash, which is this sort of internal currency that can be redeemed for real cash or prizes. But the rules state, and this applies to like how we regulate gambling versus lotteries in the US, you can't purchase covered cash technically, because if you could, then you'd be gambling. So instead, you can obtain covered cash by converting your credit card rewards into covered cash. You can buy practice coins, which are like a non-redeemable token that you can use to play the games, but then they also come with a certain amount of bonus covered cash that you get. You can get covered cash just randomly through like social media promotions, or, and this is the other thing that ties to like lottery rules, they have to make it so that you can write in, like on a physical piece of mail, write in to get covered cash for free. But the rules around how that write-in works make it so that no one is actually ever going to do that. So the thesis, I guess, for this is by building this sort of like addictively compulsive card with these rewards and then offering this sort of sweepstakes gamified capability in the app, that acts as like the customer acquisition wedge that brings people to the product. And then what they talked about is a long-term plan for monetizing those users by cross-selling them other financial products like auto loans and mortgages and other types of things. Simon, I would say I am sort of predisposed to hate this. And so
Yeah.
I've been trying to sort of look at it in the most rational way possible and not let like my natural allergies around this stuff overly color my analysis. But just as a product design principle, I'm not wild about it. What are your thoughts?
I'm going to try and steelman this because
Okay,
I am
please.
fintech's perennial optimist.
You are.
You know, I keep hoping for better things, and I keep trying to see the good in everything, even when it lets you down and I'm the disappointed dad. I'm struggling on this one.
It's hard.
I'm struggling. Like, where's the social utility at all? Just ew. I'm really struggling.
And well, it's interesting because like I couldn't agree more. And like just to illustrate the part of it, YOLO Investing is one of the companies that invested in them. And if you look up, I'm not going to specify what YOLO Investing is because I don't want to. But if you Google them, like it's exactly the people you don't want investing in consumer fintech. This also came out of A16Z's Speedrun Accelerator, which, to be honest, is kind of a horror show of the things that create that disappointed dad vibe if you look at the portfolio page. So it's trying to think of the right way to frame my objection to it. The card itself is whatever, right? Like it's a different way of doing rewards. It probably does appeal to a segment of the population. It doesn't really by itself seem that bad. The sweepstakes thing, which is where they started, and it still exists as a part of the product, as I understand it, that's the part that kind of tells me like just how you're approaching building in this space, and it's what creates it, that pessimism and that like hard to steel man and see the positive side.
if I had to do it, and you said, Simon, your life depends on making the best case for this possible, then it is extremely hard to win at customer acquisition. It's extremely hard to get anybody to pay attention. It's extremely hard to get anything top of wallet. And right now, we are in a casino economy, whether you like it or not.
That's right.
Biff Tannen won. It's Biff Tannen's America, and everything's a casino. So realistically, how bad is it that a rinky-dink credit card is directing some spend that you would have done anyway towards something that you might be able to create social utility with, like an auto-tone loan later?
Sure.
I would love to see underneath this the credit building aspect of it.
Yeah.
You show me that, where this is like, look, there's a generation of people, there is a segment of the population for whom they are going to be wildly irresponsible. So let's pull them towards this and default them into something that is a little bit better for them, and gradually start to rehabilitate that. Not in like a paternalistic, we are, here to save the universe sort of thing. I don't think
Just
you need to
like,
be that.
Nudging, just nudging in this direction.
You know what? Credit where it's due. Robinhood. I have my misgivings about how aggressively they will go into the casino, but you know what? They have some of the best products on the planet when it comes to credit cards and retirement accounts. They have got the balance, and it's available in the shop window, and they're thoughtful about how they're doing it. And I don't have to like it to know that it can be really, really effective, and that you can drive people in that direction. So I hope that's what Covered are doing.
Well said. Mm-hmm.
And they have that opportunity in front of them. Sometimes your kid makes a mistake, and you got to love them anyway.
It is very true, and actually relevant to the last thing I wanted to talk about with you, Simon, which is normally we manifest a fintech idea. I think we've already done a pretty good job of sort of painting a picture of the future that we think we're going to see and want to see. Instead, I want to talk to you as a father of daughters for a moment.
Yes.
And I wrote in my newsletter recently that I had the privilege of getting to sort of help introduce my daughter, who's 3, to Frozen, which is a movie she had never seen before. And I had not realized, being an adult man when I first saw Frozen, loved it, by the way, I had not realized that as much as I like that movie for like young girls is like, I've never seen anything like, it's like the perfect form of product market fit. Like my daughter is just obsessed with Frozen, and instantly it happened. I know you've had a similar experience. So what's been the Frozen experience in your household? Can we talk this out for a second?
I have, for the past 3 years, tried to convince my eldest that Anna is clearly the protagonist here, and just gently trying to nudge her towards, like, look, she saves her sister. Her sister gets angry at everybody. Her sister won't take responsibility for her actions. Her sister keeps hurting people. Her sister is scared of everything. Her sister keeps running away. Her sister is not brave. Anna keeps trying to rescue her sister, even when she's like frozen her, and she will go through the Arctic to continue to save her without magic powers, by the way, and does it time and time again. The protagonist has a sidekick in Olaf. The protagonist has a love interest. Like, she's clearly the protagonist in this, and the likable one. And with dual love interests, Elsa is away in a castle just dealing with her own crap and lost in her own world.
Like, not that she's the villain, but like for the purposes of storytelling in a Joseph Campbell sense, she plays that role in the movie, literally. Or I guess you could say her powers do, but like, it's weird because everything you just said, 100% agree with. Couldn't agree with more. And yet, who does my daughter want to be for Halloween this year? Elsa. She wants to be Elsa, and like, let it go. And like, I get it. Like, I understand, but it is so fascinating that like the aesthetic of the movie pushes you towards Elsa, but everything about how you want your daughter to grow up and the person you want her to become, you want her to be Anna.
Yeah, and maybe that is just the issue here. Now, thankfully, I have 2 daughters, and my 2.5-year-old immediately identified as Anna, and also, I don't know if you're a Peppa Pig household, but she immediately identified as Georgie Pig, which I just just broke my heart. I was like, oh, you're you're the smaller one, and you're the sidekick, and that you've come along second. But that makes you amazing because, like,
That's right.
no, you're important too, second child.
That is amazing. My daughter is also a big Peppa Pig fan. I think she had the benefit of being the only girl in the household, so she got to sort of see herself in Peppa, not like the sibling. But yeah, I mean, her attraction to Anna or to Elsa over Anna makes me nervous. I also,
It's
Simon
concerning.
will say, yeah, and well, like, you know, I understand that there's a Frozen 3 in the works, and so like I just have questions about, like, I don't know, the plot.
So
I'm
Frozen
very
2
involved
is
in Frozen.
objectively like Elsa's redemption arc, and
I guess, yeah.
And it's better. It's the roles have reversed. Like, she's now saving
Yes.
Anna a little bit and coming back in her own way. Sort of becoming a grown up finally. So that's allowable, but it's just like the songs are not as good. And so the little kids don't really pay attention to that. Let me just leave you with one last thought.
Please.
Right at the end of the movie, Anna throws herself in front of a sword to save Elsa. And that act of selfless love is what thaws her own frozen heart and repairs her bond with the sister. Like, it's Anna. It's clearly Anna.
It is
that
absolutely
right there is the soundbite for the show.
It is absolutely. But might name the episode that. Simon, that is a wonderful place to leave it. I knew I could count on you for a good fatherly rant about the sort of hidden messages of Frozen. I also know I could count on you for some wonderful and very fascinating fintech and AI talk. As always, a pleasure, sir, and we will have you back again soon. I promise.
I look forward to it. Take care, sir. Bye for now.
Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.